How liquid is the CALF ETF in terms of trading volume? The liquidity of the CALF ETF, Pacer US Small Cap Cash, CAUS 100 ETF, can be considered moderate. Here's a breakdown of factors affecting its liquidity and how it compares to other options. Trading volume. Trading volume refers to the total number of shares of an ETF that are traded on an exchange in a given period, typically a day. A higher trading volume generally indicates better liquidity because it suggests there are more buyers and sellers actively participating in the market. While there isn't a universally accepted threshold for liquidity, ETFs with average daily trading volumes above 1 million shares are often considered reasonably liquid. CALF ETF's trading volume. The average daily trading volume for CALF can vary depending on market conditions and overall investor interest in small-cap stocks. It typically falls within the range of 500,000 to 2 million shares traded per day. This suggests moderate liquidity. Comparison to other ETFs. Large cap and broad market ETFs generally have significantly higher trading volumes compared to CALF. These ETFs might have daily volumes exceeding tens of millions of shares. Compared to other small-cap ETFs, CALF's liquidity falls somewhere in the middle. Some small-cap ETFs might have even lower trading volumes, making them less liquid. Impact of liquidity. Order execution. With moderate liquidity, there's a generally good chance of executing buy and sell orders for CALF at or near the current market price. However, during periods of high volatility or lower trading activity, there might be slight price discrepancies when entering or exiting positions. Bid-ask spread. The bid-ask spread represents the difference between the highest price a buyer is willing to pay, bid, and the lowest price a seller is willing to accept, ask, for an ETF share. In a less liquid ETF like CALF, the bid-ask spread might be slightly wider compared to highly liquid ETFs. This means you might get a slightly lower price when selling or pay a slightly higher price when buying shares. How does the correlation coefficient of the CALF ETF compare to other asset classes? The CALF ETF, Pacer US Small Cap Cash CAUS 100 ETF, likely has a moderate to low correlation with other major asset classes. Here's a breakdown of why and how it might compare. Understanding correlation coefficient. The correlation coefficient is a statistical measure that indicates the degree to which two investments move in tandem. It ranges from -1, perfect negative correlation, to +1, perfect positive correlation, with 0 indicating no correlation. Expected correlation of CALF ETF. Stocks. Since CALF invests in U.S. small-cap stocks, it's likely to exhibit a positive correlation with the overall stock market, particularly the small-cap segment. However, the focus on companies with strong cash flow generation might lead to some imperfect correlation. During economic downturns, for example, high cash flow companies might be more resilient than the broader market, reducing the correlation somewhat. Bonds. Bonds generally have a negative correlation with stocks. When stock prices decline, bond prices typically rise, and vice versa. Therefore, CALF is likely to have a low negative correlation with bonds. Commodities. The correlation between CALF and commodities can vary depending on the specific commodity. Some commodities might have a positive or negative correlation with stocks, depending on economic conditions. Overall, the correlation is likely to be weak or moderate in either direction. Real estate. Real estate investment trusts, REITs, can be considered a sub-asset class of real estate. REITs might have a moderate positive correlation with stocks, but a weaker correlation with small-cap stocks. Therefore, CALF's correlation with real estate is likely to be weak and potentially slightly positive. Does the CALF ETF invest in any specific company size? Yes, the CALF ETF, Pacer US Small Cap Cash CAUS 100 ETF, invests specifically in small-cap companies. Here's a breakdown of the concept of company size and how CALF targets this particular segment of the market. Company size classification. Stock markets typically categorize companies based on their market capitalization, which is the total market value of all outstanding shares. There's no universally agreed upon standard for these classifications, but a common breakdown is: large cap, companies with a market capitalization exceeding $10 billion. Mid cap, companies with a market capitalization between $2 billion and $10 billion, ranges can vary. Small cap, companies with a market capitalization below $2 billion, ranges can vary. CALF ETF's focus. The CALF ETF specifically targets small-cap companies. The underlying index it tracks, the Pacer U.S. Small Cap Cash Cows Index, starts with the SP Small Cap 600 Index, a benchmark that represents the 600 smallest publicly traded companies domiciled in the United States. Investment strategy and small-cap focus. The investment philosophy of CALF revolves around identifying high-quality small-cap companies with strong free cash flow generation. Small-cap companies are generally younger businesses with higher growth potential, but also greater inherent risk compared to larger, more established companies. By focusing on small-cap stocks, CALF aims to capture this potential for growth while prioritizing companies with a financial metric, free cash flow, that suggests they have the resources to reinvest and potentially achieve future success. Investor considerations. Small-cap stocks are generally more volatile than large-cap stocks. Their share prices can fluctuate more significantly in response to market movements, company news, or broader economic conditions. This can lead to larger potential losses for investors. While small-cap companies offer the potential for higher growth, they also come with a higher degree of risk. Consider your risk tolerance and investment goals before investing in CALF. What is the weighting methodology used for the holdings within the CALF ETF? The CALF ETF, Pacer U.S. Small Cap Cash Cows 100 ETF, utilizes a two-step weighting methodology for its holdings. 1. Selection based on free cash flow yield. The ETF tracks the Pacer U.S. Small Cap Cash Cows Index. This index begins by referencing the SP Small Cap 600 Index, which represents the 600 smallest publicly traded companies in the U.S. The index then applies a screening process based on free cash flow, FCF, yield. FCF is a metric that measures the cash a company generates after accounting for its operating expenses and capital expenditures. Companies with high FCF are considered financially healthy and have the flexibility to reinvest in growth or distribute dividends to shareholders. FCF yield is calculated by dividing the company's annual FCF by its current market capitalization. Essentially, it represents the percentage return on investment from the company's free cash flow. From the SP Small Cap 600 universe, the index selects the top 100 companies with the highest FCF yields to become the holdings within the CALF ETF. 2. Capping individual holdings. Once the top 100 companies are selected based on FCF yield, a weighting cap of 2% is applied to each individual holding within the ETF. This capping mechanism serves two purposes. Diversification. By limiting the weight of any single company to 2%, the ETF avoids overweighting the portfolio towards a specific company, even if it has the highest FCF yield. This helps to spread risk across the 100 holdings and enhances overall portfolio diversification. Reduced concentration risk. An uncapped weighting methodology could lead to a situation where a handful of companies with the absolute highest FCF yields dominate the ETF's holdings. This concentration risk could amplify the impact of negative news or events specific to those companies on the overall performance of the ETF. How frequently are the holdings of the CALF ETF rebalanced? The holdings of the CALF ETF, Pacer US Small Cap Cash Cows 100 ETF, are rebalanced quarterly, typically around the end of March, June, September, and December. Here's a breakdown of the rebalancing process and its implications. Rebalancing schedule. The Pacer US Small Cap Cash Cows Index, which the CALF ETF tracks, undergoes rebalancing on a quarterly basis. This means the holdings and their weightings within the index, and consequently, within the ETF, are reassessed and adjusted every 3 months. Reasons for rebalancing. Maintaining FCF focus. Quarterly rebalancing ensures the ETF continues to prioritize companies with the highest FCF yields within the SP Smallcap 600 universe. As company financials and market conditions change, some holdings might experience fluctuations in their FCF yield. Rebalancing allows the ETF to remove companies whose FCF yield has fallen below a certain threshold and replace them with those exhibiting stronger cash flow generation. Weighting discipline. Due to market movements and company performance, the weights of individual holdings within the ETF can drift away from the target 2% cap over time. Rebalancing helps to bring the weightings back in line with the 2% limit, maintaining diversification and managing concentration risk. Impact of rebalancing. Transaction costs. Rebalancing involves buying and selling securities to adjust the holdings and their weights within the ETF. These transactions incur costs, commissions, bid-ask spreads, that are ultimately borne by the ETF shareholders through a slight reduction in the overall net asset value, NAV, of the ETF. Tax implications. Depending on the specific rebalancing activity and how the ETF is structured, there might be some tax implications for shareholders due to potential capital gains distributions. How does the dividend yield of the CALF ETF compare to other investment options? The CALF ETF, Pacer US Small Cap Cash Cows 100 ETF, generally offers a dividend yield that falls somewhere between large cap stocks and high yield alternatives. Here's a breakdown of how it compares. CALF ETF's dividend yield. The CALF ETF has a dividend yield typically ranging between 0.5% and 1%. This yield can fluctuate depending on the dividend payouts of the underlying holdings within the ETF and changes in the overall market environment. Factors affecting dividend yield. Focus on small cap companies. Small cap companies are typically in a growth phase and might prioritize reinvesting their profits back into the business for expansion rather than distributing large dividends to shareholders. This can lead to a lower overall dividend yield for the CALF ETF compared to some income-oriented options. Free cash flow focus. While the ETF prioritizes companies with strong free cash flow, this doesn't necessarily guarantee high dividend payouts. Companies might choose to utilize their cash flow for various purposes, including debt reduction, share buybacks, or strategic acquisitions, besides dividends. Comparison to other options. Large cap stocks. Large cap, well-established companies might offer dividend yields in the range of 1.5% to 3%. These companies are often financially mature and have a larger portion of their cash flow available for distribution to shareholders. High-yield investments. Options like high-yield bonds or dividend-focused ETFs specifically targeting high-yield sectors can offer dividend yields exceeding 4%. However, these investments come with greater risk, as the companies issuing the high-yield bonds or the underlying holdings within the high-yield ETF might have weaker creditworthiness or operate in volatile sectors. How do the expense ratios and fees of alternative ETFs compare to the CALF ETF? The CALF ETF, Pacer US Small Cap Cash Cows 100 ETF, has an expense ratio of 0.59%. This expense ratio represents the annual management fee that covers the costs of operating the ETF, including administration, research, and marketing. Here's how this expense ratio compares to alternative ETFs with similar investment strategies. Alternative ETFs and expense ratios. iShares SP Small Cap 600 Value ETF, VIOO, expense ratio of 0.35%. SPDR Portfolio Small Cap Value ETF, SPSM, expense ratio of 0.20%. ALPSO Shares US Small Cap Quality Dividend ETF, OUSM, expense ratio of 0.65%. Observations. Generally lower expense ratios, the alternative ETFs mentioned above tend to have lower expense ratios compared to CAF. This can be because they track broader, more established indexes, potentially leading to economies of scale in terms of management costs. OUSM as an exception, the ALPSO Shares US Small Cap Quality Dividend ETF, OUSM, has a slightly higher expense ratio, 0.65%, compared to CAF, 0.59%. This could be due to the more complex selection process involved in identifying small-cap companies based on profitability, balance sheet strength, and consistent dividend payouts. What are the potential advantages and disadvantages of investing in individual stocks instead of the CAF ETF? Here's a breakdown of the potential advantages and disadvantages of investing in individual stocks compared to the CAF ETF, Pacer US Small Cap Cash Cows 100 ETF. Investing in individual stocks. Advantages. Higher potential returns. By picking the right stocks with strong growth potential, you could potentially achieve higher returns compared to the overall performance of the CAF ETF. Greater control. You have complete control over your investment decisions, choosing specific companies you believe in and tailoring your portfolio to your specific risk tolerance and investment goals. Direct exposure to specific companies. You gain direct exposure to the fortunes of the companies you invest in, potentially benefiting from positive news or developments specific to those companies. Disadvantages. Higher risk. Individual stocks are generally more volatile than ETFs. The performance of a single company can significantly impact your overall portfolio value. Inherent risks like company mismanagement, industry downturns, or broader economic issues can lead to larger losses compared to a diversified ETF. Time commitment. In-depth research and analysis are required to select individual stocks with strong fundamentals and growth potential. You'll need to stay updated on company news and industry trends to make informed investment decisions. Lack of diversification. Owning a small number of individual stocks exposes your portfolio to concentration risk. If a few of your chosen companies perform poorly, your overall returns can suffer significantly. Investing in the CAF ETF. Advantages. Diversification. The CAF ETF holds 100 small-cap companies, providing instant diversification and reducing concentration risk. Even if a few holdings perform poorly, the impact on your overall investment is lessened. Lower risk. Diversification through the ETF helps mitigate the volatility associated with individual stocks. Convenience. ETFs are passively managed, requiring less research and analysis compared to individual stock picking. You can invest in a basket of small-cap companies with a specific investment strategy, FCF focus in CAF's case, through a single holding. Disadvantages. Capped potential returns. The ETF's performance is tied to the underlying holdings and the overall market performance of small-cap stocks. You might miss out on the exceptional returns achievable by picking a breakout individual stock. Management fees. The CAF ETF has an expense ratio of 0.59%, which reduces your overall returns compared to directly investing in underlying stocks, though buying and selling individual stocks would likely incur commission fees as well. Indirect exposure. You don't have direct control over the specific companies within the ETF. The holdings selection and weighting are determined by the ETF's underlying index. How does the CALF ETF compare to actively managed mutual funds that invest in similar sectors or industries? The CALF ETF, Pacer US Small Cap Cash CAUS 100 ETF, offers a distinct approach compared to actively managed mutual funds targeting similar sectors or industries, particularly small-cap stocks. Here's a breakdown of the key differences. Investment strategy. CALF ETF, passive, tracks the Pacer US Small Cap Cash CAUS Index, which passively selects and weights holdings based on free cash flow yield. The ETF doesn't involve any active management decisions regarding individual stock selection or portfolio weighting. Actively managed mutual funds employ portfolio managers who actively research and select companies within a specific sector or industry based on their judgment and investment thesis. The holdings and weightings within the mutual fund can change dynamically based on the manager's outlook. Costs. CALF ETF typically has a lower expense ratio, around 0.59%, compared to actively managed mutual funds. Expense ratios for actively managed small-cap mutual funds can range from 1% to 2% or more, reflecting the compensation for the portfolio manager's expertise. Performance. Historical performance. Passively managed funds like ETFs haven't historically outperformed actively managed funds on average over longer periods. However, actively managed funds can potentially outperform the market if the portfolio manager makes successful investment calls. Focus on FCF. The CALF ETF's focus on free cash flow yield might lead to different performance compared to an actively managed small-cap fund. Actively managed funds might prioritize other factors like growth potential or valuation metrics. Transparency. CALF ETF, the holdings and weightings within the ETF are transparent and publicly available. Investors know exactly which companies they are invested in and their weightings within the ETF. Actively managed mutual funds. The holdings and weightings within actively managed funds might not be disclosed daily and can change based on the manager's decisions. Investors might have less transparency into the specific companies they are invested in at any given time. Tax implications. CALF ETF, depending on the structure of the ETF and how it's traded, there might be some tax implications due to potential capital gains distributions from rebalancing activity. Actively managed mutual funds. Active trading within the mutual fund can lead to more frequent capital gains distributions for investors, which could have tax consequences. Could a combination of other ETFs or investment products achieve similar diversification to the CALF ETF? Yes, a combination of other ETFs or investment products can achieve similar diversification to the CALF ETF, Pacer US Small Cap Cash CAUS 100 ETF. Here's how you can potentially replicate or even achieve broader diversification. Understanding CALF ETF's diversification. The CALF ETF offers diversification by holding 100 small-cap companies with a focus on free cash flow yield. However, it's limited to the small-cap segment of the U.S. stock market. Alternative strategies for diversification. 1. Multi-cap ETFs. Consider combining ETFs that cover different market capitalizations, large cap, mid cap, and small cap, to achieve broader diversification across the entire U.S. stock market. Example, you could combine an SP 500 ETF, large cap, an SP 400 mid cap ETF, mid cap, and a small cap ETF, potentially a broader small cap ETF than CALF, to achieve a more balanced exposure. 2. Sector ETFs. If you're interested in specific sectors beyond just small cap companies, explore sector-specific ETFs. These ETFs focus on specific industries like technology, healthcare, or financials. Example, you could combine a small-cap ETF with a technology sector ETF and a healthcare sector ETF to achieve diversification across sectors and company sizes. 3. International ETFs. Consider adding international exposure to your portfolio by including ETFs that invest in developed or emerging markets. Example, you could combine a small-cap ETF with a developed markets ETF and an emerging markets ETF to achieve global diversification. Additional investment products. Bonds. Adding a bond ETF to your mix can further diversify your portfolio and potentially provide stability during market downturns. Benefits of combining ETFs. Greater control. You can tailor the diversification to your specific risk tolerance and investment goals by choosing ETFs that target specific market segments or sectors. Potentially lower costs. Depending on the chosen ETFs, you might achieve a similar level of diversification with a lower overall expense ratio compared to CAF. Challenges of combining ETFs. Complexity. Managing and rebalancing a portfolio with multiple ETFs requires more effort compared to holding a single ETF like CAF. Research needs. You'll need to research and select individual ETFs that align with your investment strategy. That's all the cash cow chat we have for today. So, to recap. The CAF ETF offers a unique way to invest in small-cap companies with strong free cash flow generation. It provides diversification through its 100-holding portfolio, but is limited to the U.S. small-cap market. While it has a lower cost compared to actively managed funds, its performance might be capped by its focus on FCF yield. We also explored how you can potentially achieve similar or even broader diversification by combining other ETFs or investment products. This can give you more control over your portfolio's asset allocation and potentially lower costs, but requires more research and management effort. No matter which path you choose, remember, diversification is key. Whether you go with CAF or build your own ETF basket, make sure it aligns with your risk tolerance and investment goals. If you're curious about learning more about building your own diversified portfolio with ETFs, or if you have any questions about the CAF ETF specifically, leave a comment down below and let's chat. Don't forget to like this video and subscribe to the channel for more in-depth ETF explorations.